Have you ever thought, what if I lose money when I start investing? Yep, I've been there. And in my first year, I lost over 1,000 euros doing things I thought were smart, but turned out to be classic beginner mistakes. In this video, I'll walk you through quite a few things. What I did wrong, what I'd do differently if I started today, and how you can skip the pain and start investing smarter with less stress and more confidence. Let's get into this. Let's rewind first. I was 18, excited to build wealth. I opened my first brokerage account, threw money at a few Baltic stocks I'd heard good things about, and boom, I was officially an investor, or so I thought. The truth? I was guessing. Some stocks went up a little, but others tanked. I didn't understand how to research them, how to diversify, or even what fees I was paying. I ended up selling at a loss because I panicked when things dropped. Now, what I do differently now? First of all, start with broad market ETFs, like 𝐸VDA or SPYL. That decision alone would spread my risk across hundreds of companies. No stress, no stock picking, just simple, slow and steady growth. Now, if I want to compare one option and another, first thing, SPYL, tick this box. Next thing, 𝐸VDA. Next. You might never heard about any of these indices or ETFs. Now, if I compare them, compare selection in detail, this website, justetf.com, gives me an opportunity to identify individual ETFs and investigate them in more details. We can see one of them follows S&P 500, which is 500 top biggest American companies. Another one, MSCI World, so all developed market altogether. We have all the details. One costs about 90 euros, another one 11 euros. The sizes, the expense ratios, what indexes it follows, and especially kids and fact sheets. If we open, for example, one of the fact sheets, we'll have more details of what it invests in. But to make it very understandable, through SPDR S&P 500, you invest in 500 American companies, like top American companies. MSCI World focuses on developed markets. So you start getting not only America, but all the rest, like Europe, Canada, so on and so on and so on, like Japan and initially all developed market altogether. You can always open this and you can always have a look at the holdings where you can see that it's United States 70%, Japan, United Kingdom, Canada, so on and so on and so on. And it gives you quite detailed reports on like where you invest. Again, we'll talk more about specific indices later, but let's talk about mistakes further. Next mistake, I chased hype. At one point, I bought into a random crypto coin just because a friend mentioned it had huge upside. Spoiler alert, I think I lost about 70% in 3 weeks. It felt like investing, but I was just gambling with extra steps. Now, what I do different on that point, set clear goals. Ask yourself, why am I investing? If the answer isn't to build long-term wealth slowly, you're probably taking too much risk. You might just not be aware of it. The boring route is often the best one. It just takes us quite a bit of time to get there and to actually trust the process. Now, the last big mistake was not understanding the fees. I signed up for the first platform I found. It looked great, but the fees were quietly eating my returns. Every time I bought or sold something, it cost me quite a bit of money. And those small percentages, they add up quite fast. It also surprised me when I started diving deeper in active funds and the total expense ratios. Let me show you an example on that one. Now, some of the platforms suggest that active funds with like 1% active management fee can earn you a great amount of money. Now, there's a lot of statistics why they don't earn anything for you, but let's say you start with 10,000 euros and you continue by investing another 10,000 each year. Now, annual expected return, let's say it's 10% either way. Expense ratio sometimes can go all the way to like 3%, but let's take a smaller one. Let's say expense ratio is 1%, which active fund has no problem to achieve this. And let's take long-term sort of solution, which is 30 years. Now, total cost of the fund is 323,000. So imagine if your expense ratio is 1%, you initially spent over that period of time 323,000. Now, if I reduce it by 0.1, look at this number, 323. I just saved almost 30 grand. Now, if I go into example, for example, MSCI World, which is more expensive option, it's 0.2. So let's have a look. 1%, 323, 0.2, 70K. 250K saved simply by picking a less expensive fund with exactly the same return. Since then, I'm staying away from active funds altogether. Now, what I do now, choose a platform with low fees and transparent pricing. Personally, I use Freedom24 because it's beginner friendly, regulated, and easy to navigate. If you do want to check it out, I'll leave a link in the description. And I always stay with passive ETFs. So after losing that first 1,000, I finally did what I should have done earlier. I took a step back. I learned about dollar cost averaging, investing small amounts periodically, and no matter what the market does. I simplified my portfolio to a very few specific funds, I tracked my returns, and most importantly, I stopped chasing quick wins. Now my portfolio is stable, growing, and really stress-free. If you're just getting started and want to avoid these mistakes, start small, pick a solid ETF, automate your monthly investing. And don't forget, choose a platform that makes it easy to stay consistent. If this video helped, hit that like and subscribe button so you don't miss the next one. Thanks for watching, and I'll see you next time.